Rajesh Kothari, Johnson, Director of IFAC. Rajesh, good having you. Thanks so much for joining in. At the outset, let me ask you, are you sitting on any cash in your client portfolios right now, anticipating any falls, or are you fully invested?
Neeraj, basically we reached around 18 to 22% cash levels in the client's portfolio. Of course, this is for the old clients. For new clients, we are having significant cash. But then what we did is that about roughly 6 to 7% we redeployed into the market, taking advantage of correction which came, sharp correction which came in between. And right now we are holding, as we speak, roughly about 11 to 13% cash.
Rajesh, what happens to discretionary consumption in the current point? I'm not talking about staples, non-staples. Would you consider taking a bet because of the fall in prices, or are the valuations difficult to determine right now because you don't know what the earnings impact would be?
Well, I think Neeraj, it is very, very clear to us that in FY21 is going to be washout year for most of the companies, irrespective of which sector we belong to. Yes, earnings can be 10% degrowth or 30% degrowth or 50% degrowth, depending upon segment in which you are present. So say, for example, if you are into specialty pharmaceutical, or if you are into FMCG, or if you are into agriculture-related company, then earnings degrowth might be mild. But any other segment, earnings is going to be, medium to high level. But what we have done is that for us, what we are now incrementally looking at is FY22, and we are asking very simple questions to ourselves that whether FY22 is going to be higher than FY20 or not. It's a very simple thing, because there is a lot of noise around. Uncertainty is highest. Everyday markets are going to be either plus 2% or minus 2%, that too opening up with a gap or opening down with a gap. So you don't have time to act and react and act and react. You can't do that every day, correct? So, very important question, fundamental question, whether FY22 is going to be higher than FY20. And if answer is yes, whether valuations are already pricing in, or you have some room for, further valuation re-rating whenever people start looking at FY22. And depending upon answer to that question, we position ourselves, well. So, irrespective whether it is even if it is discretionary, FY20 is going to be a very bad year. It is not about April. I think it is going to, normalcy will come back only from September or October. So FY21 is going to be a washout year for most of the companies, irrespective of which sector you are.
Okay. Rajesh, so should one anticipate, obviously, FY20 earnings are put on the back burner, but even FY21 earnings, while there will be a gradual recovery, it may not be up to scale, and therefore maybe investment decisions can be delayed a bit?
Absolutely, that's what exactly what I'm saying. That FY20, you should take FY20 as your EPS for FY22. If it is a good company, it can be a little bit higher. If it is a not that great company, it will be significantly lower. FY21 is going to be a bad year because your first month is gone. It is not only about first month, probably 45 to 60 days are gone. And from third month, you will see 30, 40, 50% utilization. And as we move towards September, you will see, coming back to normalcy very gradually. And this also, mind you, assumes a lot of things. So there is no point of looking at FY21 because point is how much pricing is already started discounting it. So market is always ahead of time. In fact, according to the Bloomberg Intelligence chart, market is roughly 200 to 300 days in advance to the corporate earnings bottom and GDP bottom. Market bottoms about 200 days before the GDP bottom and the earnings bottom. So don't look at FY21. Start looking at FY22. And there basically, if the company is good, high quality, good balance sheet, where you think these people are going to believe them, investors, bankers, everyone, then that's the company which is worth looking at. Because there is a significant dent on the valuation for many of such companies. And as we come back to normalcy, people will start looking at, those companies.
Mm-hmm. Okay. What are you making out of, the interest within some of the defensive pockets, like pharma, obviously, because they are the epicenter of, this entire issue. Pharma being one. consumption, particularly staples, because that demand is not going to go away anytime soon. And some of these diagnostic companies, not just health, not just particularly pure play pharma, but diagnostic.
Well, there are four sectors actually which are, I would say, a little bit less impacted. Impact will be there even to that companies, but impact is going to be significantly lesser. The first and foremost is pharmaceutical. Second is diagnostic chains, as you rightly mentioned, where the impact is going to be high for 1 or 2 months, but after that they'll be the first one to come back to normalcy. Then third segment is FMCG, that is staples. Then the fourth segment is agriculture related, because we should remember that last year monsoon was very good, water levels are very high, crop is going to be much better. Also, the COVID-19 has less impacted to rural population. If you look at the number of districts and the population impacted because of COVID-19 is very low if you look at rural India. And there is one more segment, fifth segment, which is also going to recover very strongly, is the specialty chemicals. Most of the companies have already announced that plants are already operational because it's considered like an essential item. So these are the 5 segments where we believe the impact is going to be low to moderate. Of course, valuations of many of these companies are already factoring in this. They are no more cheap, but that's fine because it's going to be like that. So these are the 5 segments where, if you ask me, the impact is going to be lesser.
Rajesh, if my memory serves me right, you were bullish on some of the auto ancillary players. I don't know if that view changed 3 months, 6 months, 9 months ago, but they've seen a bit of a pullback on expectations that things could improve. We were speaking to Motherson Sumi and their commentary was very bullish. How do you think about this pack now? What do you think about, say, maybe a business like Motherson Sumi, which is exposed to so many global fluctuations?
Yeah, I think short term is going to be impact is going to be definitely significant for the entire auto and civil sector, both global and local. But at the same time, if you look at a little bit futuristic, maybe 2, 3 years, 5 years view, then the valuations of these companies have corrected a lot. Number one. Number two, increasing consolidation by the customers while doing outsourcing is going to happen, which is going to be long-term structural positive for companies who have capabilities, execution capabilities, and also balance sheet strength. So it is an interesting sector. We are not holding much of auto ancillary in our portfolio, but yes, it is an interesting space, and we are monitoring it very closely.
Okay, I wonder if you believe that this oil price fall could translate into some gains for the oil marketing companies. Is it a pocket that you're looking at? Divestment, oil price correction, and when lockdown returns, business would return?
I think, Neeraj, that thesis is there for entire market, that when lockdown reverses, everything will become normal, whether it is a consumer discretionary retail place or whether it is an oil marketing company. But for time being, as you must be aware that generally speaking, we avoid most of the PSUs in the space. And commodities also we generally avoid. We do not invest in commodity stocks. So we are not trading too much into this, the oil price crash. And therefore looking into such companies for a short-term trade. No, right now we are not looking at that.
Okay. Anything that you're really convinced about or anything that you're really skeptical about?
Well, I think, our theme of 3M investment approach, market size, market share, and margin of safety, that theme is getting more and more validated in such tough times. Because whenever life is going to come back to normalcy, no doubt about it, it is a question of time, maybe another 10 days, 20 days, 30 days. And whenever that happens, the leaders, in our portfolio, because entire our portfolio consists of companies which are number 1 or number 2 or number 3 player in its own segment. And they all have either zero debt, it means zero long-term loans, zero short-term loans, or they have a debt equity less than 1:1. These companies are going to get significant benefit because of the consolidation in the industry. Many weak players are going to be out from the market. Bankers may not touch these companies. Many of such companies where the balance sheets are weak, it definitely is going to be disadvantage to them. So our portfolio companies have resilient business models with a very strong cash flows and under-leveraged balance sheet. So we are going to gain market share with 1 year, 3 year, 5 years kind of perspective. And therefore, we feel, what I would say, rightly positioned for upturn in the economy whenever economic growth and the earnings growth starts coming back. So it is not about avoiding space. Of course, we do not invest in commodities. We do not invest in metals, oil, and such companies and such sectors one should always avoid. And that again proves that why one should avoid, because you can't predict when the commodity price goes down 10, 20, 30, 40, 50%, and your stock price will be down probably 90%. You should avoid that space. That's number one. Number two, we should avoid any companies who have a weak management, weak corporate governance, weak balance sheet. And time and again, it is proven that, if you make any mistakes, then markets are not in a mood to pardon your mistake. And in such times, stocks goes down 70, 80, 90%. And therefore, it is a more of a portfolio quality and the resilient business model. I'm again using this word because not every company is a resilient business model. Think of a company which might be a great company, but 70% of its revenue coming from one particular market or one customer, and that customer is under problem. That business model is no more resilient, correct? So you need to look at the business model very closely, how resilient the business model is in terms of the cost curve, in terms of the diversification within customers, diversification within geographies, diversification within products, and all these things are very, very important. And then you start looking at the, building the portfolio. So that's again very, very important, the resiliency of the business model. And I think this time is again going to make some permanent change in the cost curves of many companies because companies are working very hard to reduce their cost further. And part of this cost cut is going to be permanent. And then again boost the ROE of such strong business models.